Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. And we're taking a closer look at the impact coronavirus is set to have on widely held stock market giants Apple and Disney this quarter and beyond. The chief investment strategist of William O'Neill & Company is here to discuss. We'll also walk you through the technical market action that led IBD to raise the caution flag before the widespread losses started piling up, and what you should be doing now. Plus, we're sitting down with Bain & Company to get a detailed look at the economic and business consequences of COVID-19 and how social media is playing a key role in public sentiment like never before. And Crane Shares will shed light on emerging trends we're seeing in the China internet space, from e-commerce to education, with behavior among Chinese consumers changing as a result of the virus. Investing Strategies starts now. Well, the onset of coronavirus has hammered the stock market as investors fear the global impact could be significant and long-lasting. So let's begin with our market insights. Here now is Randy Watts. He's Chief Investment Strategist at William O'Neill & Company, an affiliate of IBD. Thanks for joining me today, Randy.
Thanks for having me.
So what do you make of this sudden and drastic shift in the tone of market conditions given the coronavirus outbreak?
So I think the market's really wrestling with two things right now. The first is that the coronavirus is obviously going to have an impact on both global GDP and also corporate earnings. And I think the market's wrestling with how big an impact is that going to be versus the fact that there is likely going to be added liquidity and lower rates from the global central banks. Stocks look attractive on a relative valuation basis. So it's not really the question of the multiple, it's more investors trying to figure out what the correct earnings are in this environment.
Right, speaking of corporate earnings, Apple definitely in the crosshairs here, announcing that it's not going to meet its revenue targets. What does this mean for Apple investors, both in the short term this quarter and what it could mean for the remainder of the year? Sure,
well I think there's two things with Apple. The first is 2020 and then the second is beyond. In terms of 2020, Apple's really being hurt two ways. The first is they get about 15% of their revenue from China. Not all of their stores are back open over there. And then also they're having an issue with parts. A lot of the supply chain for Apple is parts manufactured in China. There's a question of how fast that is going to ramp back up again. Right now we're hearing from reports out of Asia that the supply chain's not going to be back fully online until sometime in May. And I think that also causes a question for later in 2020, are any of their new 5G handsets going to be delayed in the fall? I do think for Apple, though, that demand is just being pushed out. It's not really being canceled. So we would expect those units to come back at some point. The question is it going to be in this fiscal year?
Yes, a huge year, as you mentioned, for the 5G rollout. So do you think that the bigger impact or story here with Apple is more on the supply side, how they're going to shift their plans to counteract that, more than on the demand side that's just pushing out the handset sales later in the year?
I do think it's going to be a slower year for smartphone sales. IDC was originally using up 1.5% for smartphone shipments, so that's for the whole industry, not just Apple. They've now lowered that number to minus 2.3%. So I do think it's going to be a tough year, but I would expect sales to really rebound strongly for them in 2021.
Right. Well, let's contrast this story then with another widely held name, and that's Disney. Obviously, a very different business. And would you say that the impact for Disney, stock-wise so far seems to be more significant, but whereas maybe there's a delay in handsets, are consumers going to go to a park that is now closed later in the year, or is that trip just canceled for those consumers?
I do think it's a bigger impact with Disney. Disney gets about 35% of its revenue from parks, experiences, and consumer products. Right now, Shanghai Disney, Hong Kong Disney, and Tokyo Disney are all closed. It's unclear when those are going to reopen. Paris Disney is still open, but if cases keep ramping in Europe, I think that's at risk. And I do think people are going to be less likely to go visit parks and big events where there's large crowds. So I think that some of that demand they are going to lose. And I do think there's a question of when the virus does dissipate, how quickly that business ramps up. We like Disney long term because we like what's happening on their streaming service, Disney Plus, which is already at roughly 30 million viewers. But I do think the parks business is going to be tough, and this is a real impact.
And not only do we have the coronavirus impact, but also the exit of CEO Bob Iger, who obviously did a tremendous job as CEO at Disney. a lot of expansion coming, not only on the park side, direct-to-consumer front. So how do you think that shift at the company is going to impact the stock as well? Long-term, still think that there's a lot of hope here under a new CEO's tenure?
So I think it was a lot for investors to absorb in February. You had the coronavirus news, and then you had Bob Iger really retiring to the executive chairman role. He's going to be with Disney for about another 2 years, but he's mostly going to be focusing on the creative side. They've given the CEO job to Bob Chapek, who was originally running parks, and now he's going to obviously be CEO of the whole company. So I do think that's got people a little unnerved. Again, we feel good about the content side of Disney. The question is, how quickly do the parks come back? I think longer term, the stock should be okay, but it could take a while. What we're telling investors right now is we'd like to see the stock base out and start to form the right side of a consolidation pattern before we'd want to get back involved.
Right, want to see that momentum, and it sounds like the long-term story there is still intact. Randy Watts, thank you so much for your insights today. All right, and coming up after the break, I'll be walking you through the technical market action spotted by IBD that warranted caution before the massive sell-off worsened. Back in a minute.
Are we ready to do this?
Okay, here we go.
Good morning, everyone, and welcome to IBD Live. IBD Live is for just about any investor.
IBD Live is a look behind the curtain.
It's kind of bringing our subscribers into that whole conversation that we're having on a daily basis.
You're just going to be fully immersed in the rules of growth stock investing.
I think IBD Live, honestly, is probably one of the best values out there because you get to leverage off of others' experience.
You're going to speed up your learning curve dramatically.
If you really want to know what's happening right now, what can you do today, IBD Live is where you should be.
If you capture one or two of these stocks, it's going to pay for the subscription itself.
Learning in the stock market is a lifelong adventure, and I think IBD Live helps make it an exciting and hopefully a profitable one.
When market conditions rapidly change for the worse, investors might let their emotions get the best of them and start making ill-advised portfolio decisions, like ignoring sell signals and hoping for a quick rebound, waiting and selling right at the bottom, or trying to buy merchandise that's quote-unquote on sale before momentum shifts back to the upside. But savvy investors know how to track market conditions and adjust their portfolios swiftly before conditions worsen. And waiting for a new uptrend before getting back in is key too. So let's take a closer look at the market action that led IBD to be cautious before the coronavirus-fueled sell-off worsened. Now, even before the sharp declines of late February, IBD was saying that the market could be due for a pullback. That's because when the NASDAQ was hitting new all-time highs, it was bumping up against an upper channel line. Now that indicates a pullback from those levels would be quite natural, and so was the fact that we were getting so far extended above this 21-day moving average. Also, on this down day, February 20th, the day after hitting an all-time high, that provided a tell for what was to come, even though stocks were able to close well off of lows that day. This marked a change in tone and was a clear warning sign for the uptrend by undercutting the low of February 18th in intraday trade. IBD cautioned that a break below that level in this manner was abnormal. Now the next day, the selling picked up, indicating that the market was now vulnerable. IBD warned that day that a full break to the 50-day line would be a game changer for the market in a negative way. And come the following session, that's exactly what we got. That prompted IBD to downgrade market conditions to uptrend under pressure and to market correction the following session. While many high-flying stocks now look cheaper, now is not the time to be aggressively buying stocks. We don't know when the correction will truly be over. That's why IBD waits for what we call a follow-through day as our signal to start getting back in. Just 1 or 2 days in the green after heavy losses is not enough to signal true upward momentum. Now, in a rally attempt, it's important to see at least 3 days of buying in heavy turnover to change the market tide. That's a simple explanation, but it can get a little complex, so make sure you're following IBD for up-to-date insights. Now, headlines can move markets very quickly. But again, IBD's experts are able to accurately analyze trading conditions in real time. If you pay close attention to the technical action in the major indexes, you'll be able to react more quickly and know when to get into and out of the market. Okay, so when we come back, we'll hear how Bain & Company is advising clients to adjust their business contingency policies to minimize operational disruptions caused by the coronavirus epidemic. That's after the break.
I'm Arusha Pierce, and welcome to Investing with IBD. Every week, we are going to give listeners insight on how the market is doing. We'll identify stocks or ETFs that are worth considering and adding to your watch list. Not only do we have investing experts, we like to bring on business leaders. The response from listeners has been amazing. It really feels like we're building this community. Join me every week as we take on the market. Listen and subscribe wherever you get your podcasts.
Welcome back, everyone. Joining us to discuss the economic and business consequences of COVID-19 and how social media is playing a key role in public sentiment like never before is Karen Harris. She's the Managing Director of Bain & Company's Macro Trends Group. Thanks for being here today, Karen.
Thanks for having me.
All right, so when it comes to the business impact here, making data-driven decisions is so important. So with the data that you have right now, what type of response is warranted in reaction to this crisis that we're seeing for businesses?
So we look at the data really through three lenses, which is what we would think that business people and investors should look through. The first is the science, the factual science. The second is the government or reaction. What is the public policy going to be around how to manage the crisis? And the third is the public reaction to that. And as you mentioned in your introduction, it's really this third lens that is the biggest difference in this crisis than what we've seen in prior crises. When SARS happened in 2003, it was prior to the advent of really strong social media. China's economy was, yes, much smaller, but also the number of the percent of internet penetration in China was much, much lower. Today we're operating in an environment where, well, we make fun of the millennials a little bit at times for their putting their every meal they eat on the internet, but this could be the first crisis that people document live as they go through it, and it will be far more public in that sense. And so the reaction could be quite constrained if we continue to see doctors on TV and the message is, this is just the flu. And that will keep markets orderly, it will keep reaction orderly. That's not to say optimistic, but orderly. If a video that's real or fake goes viral about someone having a dramatically bad reaction or someone famous contracts the disease, or we could see a very different swing in the epidemic. So we are alert to and looking at those public sentiments as a very important reaction. You had asked about how businesses should react, and today Bain has created what we call the SITREP, a situation response index, and we just raised that from a 4 to a 5 this week. And what that means is we're really looking today at a reaction similar to what our clients would have for a mild recession. So let's count on the fact that this is going to be a moderate 1 to 2 quarter recession-like actions today. On top of that, of course, every business is thinking about their people and how to manage and keep them safe in this environment. That, I think, goes without saying, but certainly we haven't heard a business executive anywhere who doesn't put their people front and center. But on top of that, the economic reaction is that more bounded one.
So when businesses are weighing what response they should take, clearly it seems like at this point we know that there is going to be an impact on financials to some extent, but how do companies best position themselves to come out of the other side of this crisis?
Right. So when Bain looks at even a recession or a crisis, when we think about how do you thrive or win in a downturn, there are activities that you take to think about cash management, where you want to be after the crisis. So it never pays to react sharply and shortly and in a panic in one's life, in one's business, really thinking about what are the resources we need to keep our business on a steady course through this, but also where do we want to invest now to continue to grow and thrive beyond this crisis. The place where probably the most concern now in terms of sentiment is the U.S. economy has really been growing, certainly consumer spend has been growing off the affluent sector. It's really been the spend of the more affluent, the top 20% of the population that's kept the economy above water in some senses over the last few months. We, with Dynata, have a proprietary index that Bain & Company, it's our consumer health index. And what we've seen is, first, that sentiment is almost perfectly correlated with markets, which we saw last week were not performing at their best. Today seem to be recovering. But with markets going down, the optimism of that group goes down, and therefore their intent to spend and their actions change. Right. And so we're monitoring that very closely over the next couple of weeks.
Well, we know this is a very fluid situation, but sounds like it's definitely time for businesses to have a response that's appropriate to the severity of the crisis. So we'll definitely keep tabs on this. Thanks so much for sharing with us today, Karen.
Thank you.
All right, and when we return, we're sitting down with CraneShares to talk about emerging trends in the China internet space as a result of the virus, from e-commerce to education. We'll be right back.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection. Everything within MarketSmith is designed to bring those best stocks to the surface.
And then we come up with a basket of stocks called the Growth 250.
It runs 30 different proprietary screens.
It does a lot of the work for you of filtering down to the potential leaders.
And then I need to look at the chart.
It's essentially like a baseball card. All your essential stats right there.
And now I'm looking at pattern recognition as a way of timing my buy.
So you know exactly where to buy it, where to sell it if it goes wrong, and then where to take profits.
Then I want to go set an alert on MarketSmith that tells me if that stock is getting ready to break out. We have the best team of product coaches in MarketSmith.
It's going to make things a lot easier as far as expediting your learning process and making better decisions.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
With me now to shed light on emerging China internet trends resulting from the spread of coronavirus is Brendon Ahern, the Chief Investment Officer of CraneShares. Thanks for joining me today, Brendon.
Thank you very much for the opportunity.
All right, so we know that companies like Alibaba, JD.com, already before coronavirus have just had these huge growth stories. So given the onset of coronavirus in China, how are these e-commerce companies in particular being impacted?
So surprisingly, they're actually doing well. The quarantine that China imposed, extending Chinese New Year, meant you spent more time at home in your apartment. So what did you do? You played more video games, you downloaded more videos, music, TV shows. You had to eat, so you ordered restaurant delivery. You need the food, water, toilet paper. You're using e-commerce companies and you're allowing your kids, they need to keep studying. So online education.
Yes, exactly. At IBD, we've been following the e-commerce companies in China very closely, as well as those education companies that you mentioned. So would you say that the coronavirus, obviously a very serious situation, but do you see it in the short term as a net positive for some of these companies in the internet space?
I think what you're going to see is habits are being formed, that the quarantine within China really forced people to use these companies, and in many cases for the very first time. So we think these habits that were formed during the quarantine stage in China, which we're really getting well beyond outside of Hubei province, are going to stick. I mean, that's something that the management of these companies have said repeatedly.
Okay, and in terms of the array of companies that fall under the China internet space, what else are you looking at other than e-commerce and education right now as being really key to that market?
I mean, for us, China healthcare is really an obvious one. That those names within China are outperforming the broader market in a pretty dramatic fashion. So we like healthcare. We like these internet e-commerce names. And then at the same time, I think there are areas you want to avoid. Obviously, travel, tourism, cruise ship lines, casinos, airlines. Mass events are going to come to an end, I think, here in the United States, just as we saw in China, and that hurts certain types of companies very specifically.
And whenever we do see this crisis pass, what do you think the impact will have on the long-term growth stories for, again, specifically players in e-commerce and education, which have already been standouts? Do you see the runway for growth still in the relatively early stages?
I think so. I think you're going to see a very dramatic fiscal and monetary response from the Chinese government. The Chinese government isn't lowering their 2020 GDP target. So that means the subsequent quarters are going to have to be really strong. And the China consumer, that domestic consumption story as it happens online, I think is going to see more and more support from policymakers and investors. We always want to align ourselves with those Chinese government policies.
Right. So you think the key takeaway here then is playing your spots within the China space, that there are some areas that are, in a way, benefiting and others that are not.
It's true. I mean, even in 2019, Chinese A shares went up about 35%. But if your definition of China was Hong Kong, say the Hang Seng Index only went up 13%. So a lot of what we do at Crane Shares is we want very specific types of exposures. And I think that the coronavirus, the situation, really shows that, where you need to be very specific where you place those chips. And I think, as you've seen in China, where these e-commerce companies versus, say, travel industry, tourism related stocks, that's a massive delta. And I think for investors here in the US, you should be thinking about that as well.
All right, well, lots to think about in a time like this. Very evolving situation, so we're definitely going to keep an eye on those standouts. Thanks so much for being here today.
My pleasure.
All right, and thanks everyone for watching Investing Strategies. Goodbye from New York. I'm Alissa Coram.